afternoon, everyone, and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with Nicholas Christian, CEO and co-founder of CashForce, who will be presenting on cash forecasting. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. If you are looking for a copy of the slides, we will be sending a copy through email after the presentation is complete. The last item is that we'll have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but gives us a lot of great information on how we can continue to make our webinars better for you. Now, Ken Frisco will give you a brief intro of our speaker.
Good afternoon, everybody. I'm Ken Frisco, Operating Board Director of the Federation of Credit and Financial Professionals. I'd like to welcome you to our webinar given by Nicholas Christian. Nicholas is a finance analytics expert who specializes in cash management and cash forecasting. As Roxanne said, he's the CEO and co-founder of CashForce, a new and leading cash management and forecasting platform. With CashForce, he has been working on international projects in the distribution, retail, manufacturing, and logistics industries. He also leads the R&D department within CashForce. Prior to founding CashForce, Nicholas was a management consultant at PricewaterhouseCoopers. He is also a guest speaker in the FinTech community, as well as a frequent panelist at the International Treasury Conferences. I'll turn it over to Nicholas to start the presentation.
Thank you, Ken. Thank you, Roxanne. Pleasure to be here and be the speaker here for today's presentation. Hope everyone is listening in and hear me pretty clearly. I will start off basically by saying, so the next hour will kind of fill with, I think, 50 minutes of presentation on cash flow forecasting and what's going to be basically best practices now and in the future automating the process of cash flow forecasting. Thanks to Ken and Roxanne, they already had a great presentation of who I am. But maybe to kind of have a very quick introduction of CashForce. So I'm the CEO and co-founder of CashForce, and it was 5 years ago, together with Kathleen and Bart, two other co-founders who worked actually for, I think, combined 40 years in management consulting, but more specifically on what they call business recovery services, cash flow forecasting in PwC. And together with them, we basically set up a company which would help financial professionals, but primarily treasurers and CFOs, to have a more transparency on cash flow management and forecasting. And we would do that for, as Ken said, for the mid to large companies, typically being globally represented in industries such as distribution, retail, services, telco, as well as manufacturing. So an important thing to kind of see and where we'll head to in the presentation is a lot of the companies that we work with, they have a certain degree of, I would say, complexity, whether it be the international complexity, the complexity in terms of multi-currency, multi-entity. It's always a certain complexity which makes cash flow forecasting a topic which is pretty much a hot topic today. We ourselves, we are based in Europe as well as in the US. US working from New York, and Europe expanding geographically as well. Now, but without further ado, basically going to start on the actual topic. And maybe what I wanted to do is basically introduce basically the team, the diverse team that I have, and then show you the different approaches that each of our team members had before joining CashForce on cash management and forecasting. And I think it basically, it's the main topic today, cash flow forecasting, but you can look at the topic from different angles. And I think we've in our team people that come from the audit perspective and look at cash flow just from reconciling the books, making sure you do a good review of the cash flow. But of course, that's only one perspective. When you turn on basically to another perspective, we have team members that joined from having worked in transaction services and M&A, where cash flow was not just not needed to be reviewed, but it needed to be a driving factor for the valuation and a constant look at the cash and working capital position. Now, a third angle, there were people, it was Kathleen actually, who was working in BRS, which is Recovery Services in PwC, and she was dealing only with companies that were in cash constraints, where forecasting was the tool to kind of buy time and work out a restructuring plan. So being in a cash constrained position is definitely not the position you want to be in, but then cash forecasting is the topic on the agenda because it's basically holding yourself just above the water. And the fourth angle to look at it, and probably you'll be familiar with one of the four, is we have a CFO as well within our organization that has previously worked for as a CFO for private equity-owned companies. So where cash was top of the agenda, people were not really afraid of going bankrupt, but the company needed to become lean, and cash forecasting was a measure put in place to basically make the organization more lean. And specific KPIs are typically being set up in such an environment to kind of focus on working capital management, cash forecasting, which basically are reported all the way from downstream, down in the organization, all the way to board level. So when it's these kind of diverse looks at cash flow forecasting, I would say that make the topic so exciting, but as well, which already make it different for each instance, for each case. But now we know that's an important subject. It's basically driving strategic decisions. It's a key factor for company valuations. But what makes it now so challenging? So in our presentation, we typically focus on the key challenges, and there are a few in this topic. But maybe going around as the circle defined here is basically the first question we typically ask when we meet clients is, why do you forecast? What is the reason behind the fact that you want to build a model, that you want to understand what's happening next? It can be, as you see here, for a variety of reasons, going from budget exercises to financing optimizations, but it can also be to kind of have more leverage in the banking discussions. And I think referring to, we worked with clients that are in do-it-yourself retail, and they have a specific case for looking at everything that they have in terms of financing and trying to get as accurate as they can to the cash forecast and to make sure that they can optimize that financing mechanism. Now, on the other hand, you have distributors that are within fierce bank negotiation on different facilities, and they want to prove that they actually have a mechanism in place to tell what the cash position will be, and they use cash forecasting as a lever, having more leverage in the banking negotiations. Now, the interesting part is there are different reasons, but the interesting part is that the majority, I would say, of some clients that we talk to, they are not always in a position to say why they actually do the cash forecast. So you have people that say, well, we'll need to do cash forecasting. Most of the time, they know why it should be, but the people doing the work and crunching the data in the Excels, we sometimes see that they don't know actually why they should make the forecast. So I think first, very important point to get at across the full organization, who's doing what and for which reason. Now, next thing is, if you do a cash forecast, what is a term basically that you define for your forecast? Short term, mid-term, and long term. And again, here there are so many confusions when you talk about cash forecasting. A lot the question, we want to do cash forecasting, but when it turned out and when you really deep dive into the question, for example, for an electricity provider, they have contracts with a lot of their clients that basically can forecast already the cash flows for the upcoming months and years. So for them, a short-term cash forecast sometimes takes about 12 months, while for a manufacturer who makes goods just in time and has a very short invoicing cycle, basically short-term is max 4 to 6 weeks, while for a retailer, the short-term is basically just a couple of days, sometimes hours. So the term basically is related very much to the business flow, the business and the industry itself. But we typically split it in short-term, mid-term, and long-term. I will tell a bit more about that in the coming slides. The third question is, what are you looking for? What are the specific insights? Are we looking for high-level cash forecasting, detailed cash forecasting, or you want to go into a very specific component of it, for example, looking at the FX exposure? What is the insight you're trying to gain? And fourth, I think it's the element we're always afraid of in some circumstances is, how do you deal with the continuous changes going on in your organization? And it's a bit as forecasting the weather. When you want to forecast the weather, there are so many assumptions, so many components that come into play that even people that are specialized in it, they cannot really project the weather perfectly because there are continuously changes that they haven't been calculating into their model. And I think the last one, the CEO mood of the day, is sometimes it's an interesting one because it can actually influence the cash forecast. But in most cases, new acquisitions, new alliances, new technologies can drastically change the forecast. And that's why at the same time it's so exciting, but at the other end it's so challenging to get it right. But there are ways, and of course that's the idea of the presentation, there are ways to kind of circumvent that and to see how we can make the most of this interesting subject. Now, what I wanted to demonstrate with this little demonstration is that a lot of companies, basically, when looking to these four elements, they're sometimes getting stuck and they run around in their circle and they don't know how to handle it. But we'll, of course, demystify that a little bit. Now, I explained a bit about the key challenges, but when we put it in practice, you have an organization that's spread around the world, that's having multiple entities, multiple banks, complex ERP infrastructures, accounting systems. We come across those food manufacturers that have about 7 different ERP systems just across their organization. We come across very large organizations that have 20, 30, 40 ERP systems. We also come across those that have just 3 different ERPs or 1 ERP that is so complex to get any data out of it and to get any data to work for their cash forecast. So those elements come into play, and in addition to that, we'll have the complexities within the specific processes. And when I show this to our audiences, typically I get the remark that, hey, this is a big interesting summary of our company, and in a sense, basically every activity that let the money flow through your company is basically described on this particular slide. It's describing the working capital processes from order to cash, forward to fulfill, and purchase to pay. Now, if you look at it, a lot of the companies that we see, they have a pretty good view on what's being billed and what's then producing the cash in. So 2 little steps. But it's a whole lot of more steps that have actually a cash impact and also have an impact on the cash forecast. And if you think about it, the contract terms that you set, the amount of orders, the quantity, the frequency of the orders will basically have a huge effect on your cash forecast. So we believe that each little step you need to be aware of, at least, in order to build a model that would give you a cash forecast for a particular, serving a particular purpose. So, of course, is there now a way out? Because I put all the challenges on the table, the complexities involved. So can we have a way out of this? And maybe we need to do some difference. So what I try to do now in a couple of next minutes is to kind of demystify what the components that we typically have in cash forecasting, how they look. Now, the first part of it, where we said, well, what are the terms? We typically, for cash forecasting, will first define with the business how their short-term, mid-term, and long-term is typically defined. Now, there is an interesting part here. Is I put a blue part, which is historic cash flow behavior, or the historic cash flow analysis before that. And I'll come back to that because it's only when understanding the history when you can actually project the future. But when you see this time horizon, the short term, it's defining how your cash position will go. Midterm, it's really forecasting liquidity, and long term, it's really the liquidity planning for the next years, the next years to come. But for each organization, it needs to be defined how long these terms are and what type of drivers you have in each of them. And I think that's the next part, is what is driving the forecast. Now, when looking at drivers of the forecast, business drivers, you'll get to see that for each driver and also for each term, you basically need certain elements from the different systems or sources, you could say, from your organization. And we see that here is a kind of list of the most common sources being used in the cash forecasting process. And starting on top with what typically is being used in the short-term process, it's the business data and ERP. Now, when I talk about order to cash, purchase to pay, and forecast to fulfill transactions, I mean literally order to cash. So not bill to cash, but order, shipment, delivery, invoice, and cash. So basically the full throughput from order to cash. And I think it's an important difference because we're all familiar with ERP, the accounting systems with having invoices and the payments on it. But if you want to look into the, I would say, midterm zone, in most organizations you'll find budgets to complement there, but you'll also find order schedules. And those order schedules might be in another ERP or operational system, but at least they play a value in most of the, I would say, typically manufacturing and distribution cases that we come across. A second, there is of course the business data, which is not an ERP. And that is important because when you would only make a projection as a cash forecast from ERP dumps or just the data from ERP, you would not have sufficient information. Think about if you have a leasing schedule or basically leasing payment schedule. Typically, the money is already from your bank account before you get the document, before you get the actual invoice. So if you work with direct debit, for example, you only have the document itself after you already given the cash to the counterparty. In terms of salaries, that's another one. In ERP, you can just read out what's be the historic salary payments that you did, but it's nowhere in there what's going to be the future payments in terms of salary. And so, and basically we can go a long way defining all of the business data which is not an ERP. So the combination of ERP data and non-ERP data is crucial. Treasury data is the third element. I think everyone will relate to it in loans, the deals you have, the options, the swaps, the FX options, swaps, IRS options. So all of the elements that impact the treasury part, that's a third element in terms of the sources. Typically, people will either have this in a treasury management system or have this in an Excel or have it somewhere else stored. Now, another interesting cash forecasting source is just reading out banking data. I will relate to that a little bit further in the presentation. Of course, you need to be looking at all of the different, let's say BAI, BI2, MT940, MT942, all of the different formats that are out there. And it's a lot of different formats. So I think typically we didn't talk about it as a real challenge, but sometimes this is a challenge for a lot of companies, how to get basically one format from all of these systems, while there are so many formats being offered by the banks. And I would say when looking at SWIFT, of course, trying to do a good job at standardizing that, but there are a lot of companies that either cannot afford SWIFT or either cannot just be a member of SWIFT, and they need to look for alternative solutions. And of course, then you come into the mass of different statements, bank statement formats that you need to kind of work with. Luckily, well, at CashForce, we've of course cracked that code and are compatible with a lot of those different formats. Next up is manual data. At a certain point, you don't find any information in any system, which will tell you a little bit more about the forecast, typically in the mid to long term. And then we're talking about, for example, investments that you have an acquisition, you have a specific plant that you need to construct and build. That's manual data. Then, last but not least, when you would like to make it smart, and we'll go into that a little bit deeper, a good forecast basically will also have some analytics involved, such as payment behavior of your customers or your payment behavior towards your vendors. So that's, I would say, the last component as a source to be integrated in a cash forecast. So as you see, a lot of sources, and of course they need to come together. Now we'll put it in, how do I put this in practice? What we did at Cashflows itself, we basically built that container. We built that data model which would basically consume all of the cash management and forecasting information, and it basically is fed from different angles, that what we called the sources. Now it starts with, from any ERP, whether it be SAP, Oracle, or others, will basically connect to the databases and get all of the transactional information. And I think that's another challenge is, if you have so many information, so many lines, millions of transactions, it sometimes can get quite cumbersome to do it with just an Excel at your fingertips. So we also, except for the, let's say, the working capital information, we also have the non-ERP information, where you have different financial instruments, salaries, the direct debits we talked about. We will integrate with cash forecasts and budgets from other sources. And of course, with to get a good forecast, you need to start from a bank balance as a starting point. If you have 60, 100 bank accounts around the world, if you only have 4 bank accounts around the world, it doesn't matter. You need to have a good view on what's currently on your bank account. And there we integrate as Cashflows with banks and TMSs. And you need to do that in order to build also a good cash forecast. Now, the element that I stressed on the slide is, okay, how frequently do you refresh? And I think, in a sense, when defining the terms, we said that it was different per industry and per type of company. We come across retail organizations that do this twice a week. We come across service providers that do a cash forecast twice a week, exactly when they pay out. Or we have organizations that do it only once per month. Basically, some logistical players that we know, they do it only once a month. And it always depends on what's the scrutiny of put on the subject, what's the level of detail you want to achieve, and what's the goals what are the goals that you want to achieve. But depending on them, you of course do a refresh on a daily, weekly, or monthly basis. Now, we've talked about sources, we talked about the terms, we talked about how literally we can feed all of that information on container. But I like to re-emphasize the fact that cash forecasting is an interesting subject to talk about, but it's pretty useless when you talk about the subject and you don't know what's really eating or feeding your cash today. And we get a lot of the questions. I think it was an IT service provider that was contacting us and said, well, we want to have a cash forecast. Now, having so many different entities involved in the case, the idea is, of course, on how do you basically get a view on the future when we don't understand yet what the actuals, basically, how your current cash flow goes. And I would say we're a really strong believer that first understand what's happening and then try to get a grip on the future. But now, how do you do that? Now, I'll switch from the presentation. Hopefully, you'll bear with me. I'll switch basically to quickly go into the Cashflows environment and just quickly show you an example of a consolidated cash position over time for one or more entities. And the idea is here that we want to define, okay, where does really the cash come from? Now, when clicking on the different entities, you can see the consolidated cash position. This is today, so basically we're looking backwards through time in the history of the company. And we can now split up the particular company, and we can split that up per bank account. We'll look at the different currencies. Now, when you'll split it up per bank account, you'll see a figure which is the total movement in that particular week. But what is driving or eating the cash That's what you will see when you split it by type. Now in this example, it's very easy. You just split it by vendors, by customers that provide you with, and some operational expenditures. So it's a very easy distinction, but we can make it as difficult as we want. But what is now, I would say, interesting to note is that when you have at a certain point, you want to see what's happening here. Basically, you zoom in and you want to know what's happening in that particular situation. When you zoom in, you'll see the graph actually moving into a certain number of days. And when you basically split that week into the different days, you look to the particular 15th to 16th decrease. 15 to 16, meaning 112 and 80,000 went from the account. You click on the 112,000, and what we see here is now we can see exactly what is driving it. We see the exact vendors below, and we actually see that there are two major driving factors that had a big influence on the total number. And the rest were basically very marginal transactions from a whole series of other vendors. Now, when looking at this, a lot of you will ask, how do you come basically to those particular figures here? So how do we split basically all of those cash transactions that happened in the past? I'll explain that just in 1 minute. One thing I'd like to emphasize when looking at cash forecasting, why is this so important to have a good view on the actual evolution? I just switched basically, I switched my view from the cash position. If you look at it closely, you would not say really that there is a big problem with this company. There is, of course, there are some fluctuations as you see, but it appears to be going pretty smoothly. But when you switch to what we call the net cash evolution, you basically see it's not a very stable company. You have a net cash out in August, a net cash in September, net cash out in October. So you don't want to be in the tree of this particular company, because you're basically having a very hard time to project any cash flow, as it seems it's very unstable. But now what we did is, if you click on a certain component of the cash, you can immediately see that in this case it's not really driving the instability, but if I click on one of the other parts, it's basically driving that instability. Now, just knowing that, understanding that, I think is key to kind of get moving further down to cash forecasting. And the second learning here is that if you have specific costs which are very, I would say, linear or very stable, then it's sometimes better just to take the historic assumptions into account than trying to figure out something yourself. So that's the second learning. Now, as I said, a lot of you will ask, how do you really come to this particular result? I'll through basically how did we come to that particular result. It's a question of exercise, of putting all of your companies together. What are the companies that you want to do the cash forecast, cash management for? How do you group them? How do you group them in bigger companies? What's the reporting currency? What are the banks that you are using? What are the bank accounts that you want to report on? All of the bank accounts. And finally, if you look to the overall result, basically you have all of the legal entities split by the different banks, the bank accounts, and of course the currencies. So for example, if I want to know all of my US dollar accounts, I click on US dollar and I can see exactly those accounts in US dollar. I only want to see those in Germany, or for example, only the ones from ING. I just click on that and I can see exactly in my structure where those accounts are. I can even pull some cash pool structures, because another topic in cash flow forecasting is knowing where you have the cash pools and where you need to think about or where you don't need to think about something. But having this is just the first part. Now, splitting that cash flows into those different categories, which we thought were very easy, which we had just to balance the vendors, the OPEX, and the customers. Here in this case, we basically see a split by cash flow category, and in this case it's a retail example. We can basically see and look to the operational cash streams. We can look at the cash receipts coming from different areas. We can look at the different vendors, and we can then further split vendors into different categories. So in summary, we would define our company structure. In summary, we define our cash flow categories. And then we're now up to the challenge of how do we get the actual cash flows in those categories. Now, it can sound, let's say, difficult, and in a way, it's just getting your head around how do you do that. We have different methods of doing that. We can read in bank statements. We can read, and if you look at it, it's simple. You just read in the bank statements. But typically, you'll see that those bank statements don't get enough data on it. It's just saying who what the amount is and the counterparty, typically with a customized name if you have some of the banking standards. Sometimes you even don't have the counterparty name literally on it. So in some cases, it's almost impossible to get some sort of information from just MT940 or just bank statements in general. So that's why we tend to combine MT940 files with, for example, customer and vendor data from the ERP system. And a last way to kind of split the cash into its different components and categories, that's what we call, we will look to the general ledger transactions, look to the bank statement bookings, where you basically have a rotation in cash. And in that general ledger, we'll basically decompose the general ledger. We'll look for the exact sources, whether it be customers, whether it be vendors, whether it be salaries that are paid. We'll look for the exact sources in your general ledger, whether it be an accounting or ERP system. And as you can already imagine, the first method is not really fine. It's not really granular, but you can get more granular with the method that you choose. Now, we're not having enough time today to kind of go deeply into that, but I guess the three methods already give you a good idea of how we get, first of all, a good view on what is eating or feeding your cash and what are the trends that you should take into account going forward with the cash forecast. And one of the things I touched upon when defining first the company structure, then I went to the cash flow categories. And here you see a set of categories. They are different. It's not for a retail case, but for a project type of business. Defining those categories it might sound easy, but defining them in the right way is basically defining the business drivers, your cash drivers. And then you need to link it with each of the steps that you have in this particular process. So when talking about goods delivery, basically you need to know, is this goods delivery for being invoiced to this type of customer or another type of customer? If we have a sales contract, what type of contract, what type of terms do we have? So we need to kind of link it with the actual drivers within the business. So the last step, and I think it's as important, if you have a category defined, you, for example, want to get to the cash stream of the cash coming in from customers, let's make it very simple, you need to apply a certain logic to each term that you're trying to forecast. So for example, you're trying to forecast short term what's coming in as a cash from customers. Well, in this particular case, you're looking to sales invoices in your ERP, and you're looking to the due date. Very simple, you're just looking to the due date. Of course, it's not going to be the perfect forecast, because you know that no customer pays on the due date. So that's why you, of course, need then to kind of build in average payment behavior. Having said that, average payment behavior, it's a topic. It's a topic which we can easily discuss an hour about. I hear a lot of clients saying, "Hey, apply the DSO on top of our customers or on our opening balance." Or we basically split our opening balance on our customer side in 3 groups, and then we apply the DSO to it. Where we have two, of course, dangers, I would say challenges here, is that the DSO in itself might not be the right predictor for customer payment behavior. Typically being measured at month end, sometimes being there is a spillover, sometimes not being very accurate. And in a sense, it doesn't really tell you when the customer is going to pay. So that's why we typically work with what we call the average payment behavior, or some people use the term WAPD, the weighted average payment days. And is just more accurate, just much more accurate to predict customer payment behavior. The second danger there is just splitting your customers in 3 different groups is basically you're generalizing too much, and you have so many outliers that you're going to predict something which the accuracy level is going to be too low. And that's, I would say, you need systems for that as well, to kind of, such as Casper, to really have a good view on how do I split all of my customers, how do I apply each single payment term to them, and then project using the average payment behavior. So of course, challenges in there, but I think it's a question of thinking up front about how you're going to do it, and what are the drivers, what are the logics that you're going to apply. And in the end, you're going to do a sensitivity analysis looking exactly on how customers actually pay, because you want to measure and benchmark yourself. Now on the midterm, and that's what we talked about, if you look to cash in from customers for a manufacturing company, you might look to orders on the books. You have different contracts, you have different orders that are already there, and you want them to flow into your cash in bucket. Now, the difficult thing here is that an order will eventually get a shipment, and a shipment will be delivered, and a delivery will get invoiced. But there are a couple of lead times. So that's what we call the order to invoicing lead times. And again, you could look at the average order to invoice lead time, or you could look to whatever data you already have in your ERP sitting there, which basically say that they have an expected delivery time, or sometimes they have an even promised or updated delivery lead time. And then in the long term, you of course have less accuracy. Let's agree all on that. It's going to be less accurate. But the thing is that you now can work with sales forecasts to kind of fill that last gap. One thing I didn't mention is that a lot of the companies that we started working with, they actually had 3 different terms being made for forecasting in 3 totally different systems, totally different flows. And at the end, they saw that there were major discrepancies between the 3 of them. And one advantage of taking them all into account in one exercise is that at least I would say you're trying to do it thoroughly, making sure you make sense of a cash forecast and the assumptions you make. Because if you have major discrepancies, at least one of the assumptions you make in the different terms is totally wrong. Last point on the sales forecast here. When you project long-term sales forecasting and midterm orders on the books and then short-term sales invoices, a lot of the people come to us and say, but now there's a trick I don't know. How do you basically regulate the flow from short-term, midterm, and long-term? How do you basically make sure they don't overlap? And there, of course, there are a lot of different ways to do that as well. Making sure you fulfill a certain budget or you exceed a certain budget depending on the terms, but depending on the orders you already have. So it's really making sure you do the exercise once for a specific example, and then basically making sure you validate that. I can talk a lot about that in specific. I guess the time is limited here, so if someone wants to know a little bit more about how we do that, I'm happy to talk about that. Now, other logics, of course, the cash in from customers is an easy one, but how do you project rebates, let's say, that are linked to the gross collections? How do you forecast leasing costs? How do you forecast payroll? As you see here, there are separate logics that you can apply to each. For the payroll, you can take historical information and you can make a growth assumption. Because if you have 20 different entities in a car manufacturing plant, and you know exactly how much growth you're expecting, you can basically apply sort of growth factor to that and then base the rest on historical information. Because the payroll, it's not as easy as just having the same cash out each month. It will, of course, have some seasonality or some peaks, some highs and some lows that you need to take into account from the past. And as I said before, if you, let's say, have investment cases, you sometimes just need to depend on manual input. last comment on this one. I think this one is so key for a lot of companies to have this exercise right. Now we see that when some companies that as a food manufacturer was about 6 billion that came to us, and they had around 30 entities worldwide. They all requested the local entities to provide them with a cash forecast, basically providing with all of the categories mentioned here. But for the local entities to just basically send the forecast using whatever TMS or whatever Excel spreadsheet, it's sometimes just very difficult to take into account all of these logics, take into account the data that they have, and making sense of that. Sometimes they even don't know why they make the forecast, but let's assume they know why to make the forecast. It's not an easy task if there is not a certain amount of automation in there. Now, the very logical question we have now is, so basically, how do you set that up? I won't spend too much time, basically just 1 minute on that, just showing how we set up a cash forecast. Again, you'll see the different categories that define your cash flow forecast, from the operating flows, the collections from third parties. If you click on the gross collections of third parties, you could basically say in Cashforce that a part of the data is coming from your SAP, driven from the AR balance in the short term, and taking into account real customer behavior, taking from each individual customer for a structural period of 6 months. Now the second part is, in this case, it's not even an order schedule, because in this case it was not convenient for the case, but we took a look at the sales forecast. And that sales forecast, we basically asked for that sales forecast from individual sales manager per company to load that up with a certain frequency. And if they didn't load it up, basically there is a flag that said that they still need to load that sales forecast. And there we did a proportional split of the sales forecast and the invoices that are already on the in the ERP system. So that's the way that you could set it up. And that really brings us to the question on how do currently people do it today. And if you look to the statistics, it's not looking very good. 89% of global companies basically use Excel spreadsheets to do cash forecasting, and 81% of the treasurers, when they asked for, they make the forecast in Excel, and they're saying, well, it's not accurate, and as such, it's a waste of time. So there is the question, inevitably, do you need a system? And we get the question ourselves a lot. Now, we did a kind of market survey which kind of pointed out why in a lot of cases a system is required. Now, I will already say that although you use systems, you always need to use systems with a lot of care, because assumptions are human, and assumptions are, in most cases, not driven by a system. They are human related. But in most cases, a system will basically solve complexity, as we hope to do it in a lot of cases outside of Treasury and Finance. It's coming from number crunching, time-consuming processes. One is challenge number one. Having less time for the right actions, having huge buffers, lower accuracy on the forecast. We hear the third challenge from treasurers on the market. What are the targets to set? Who are the people that we should involve in this process? And last but not least, how do we make it continuous, so that we don't need to do it once, we don't need to do once a cash forecast, we need to do it twice a week, we need to do it twice a month. And that's, of course, the major challenge. And a little word on what I said was driving one of these complexities, ERP. With Cashforce, we have, I think we've run against now 40 or 50 different ERPs, and some of the largest ones are on here. Understanding how accounting is done in your ERP is as important as understanding how the logics, basically the cash forecasting logics work. We've seen a lot of instances where, thinking about a couple of distribution and manufacturing cases, where people didn't really understand how the accounting worked in their system, so they couldn't really see where the cash was coming from, just from a couple of little exercises. And I think just knowing, I know that this is a subject that typically is a bit touchy for a lot of people, but understanding this is absolutely crucial. Now, when you got this, you connected the forecast. I'm just going to show a quick example of how a forecast could look like. When you get into a forecast, you get all these things in order. You basically have a projection rolling forwards from today into the future. You have it for different terms, so you can extend the term and say, well, we'll look forward into the future using CashForce. And on the left-hand side, we'll not only see a pretty graph, but we'll also see the cash forecast per company, potentially per bank account, and we split it further on per cash in and or cash out category. So the categories, here we are again. Now, if we maximize, we see basically a full chart of what looks a bit like an Excel spreadsheet, but now is very flexible because it involves a lot of those logics are built in here. And we have now not only something that we can show to the CFO, because this is basically you split up a cash forecast over the coming 2 months, but I can now have also a daily forecast or weekly forecast if I want, and I can immediately spot the problems on hand. One bank account that seems to be running low or running against I don't have any headroom here anymore. Basically, I can see both in a number of cases, but I can also see visually that I have a problem, and I should be investigating that problem. And when having all that data now in the background, having all those logics, I can now drill down and see exactly on this particular day, I'm losing a lot of cash. And potentially I want to know who are the exact vendors that are sitting behind that should be paid in that particular period in time. And that's, of course, having this drill down, having the availability at least to check on certain important points in your forecast is crucial. Because the next step is making simulations and making improvements. And as you saw here, you see that my cash forecast is going down, but it's going up again. So why can't I reverse basically the two parts? Why can't I basically reverse the payments with the incoming cash? Maybe call some clients or maybe call some vendors that they potentially would be okay with extending a couple of days. And that would, in this case, already save me $500,000 in liquidity that I potentially don't need to ask to my headquarters or to my bank. And that brings us basically to, when you have all of that information done, it brings us to the cherry on the cake. It's the delta analysis, knowing exactly where your delta comes from. In the gray, you see the actuals, and the orange, you see the forecast. So you could basically say they're within a certain zone, so it looks good. But you want to look at, for example, on some certain dates where the actual delta is coming from. Now at CashForce, if you have all that data, if you have all the logics, we basically will split the actual net effect into different parts where we can see which of customers have paid early or vendors were paid too early ourselves. And then we'll see what is driving the particular delta, which we hopefully will improve in the future. Doing simulations, again, it's the next step. When you have the cash forecast in order, you can do simulations. You can look how real payment behavior is put against the, I would say, default scenario of the due date payment behavior of your customers, what that effect is, a positive effect here, a negative effect here. And as you can probably imagine, you can then also do simulations on what would happen if we stretch or extend some of the vendor payments for a certain amount of time, as we had the exact, let's say, case shown here. So summary, why are you making a forecast is very important to know and understand. Understanding past to make a better forecast, defining the cash forecasting sources and logics, connecting the cash forecast with the business drivers on just a basic level, and only when all of that is done, then you could look at, okay, so what's my variance? How can I analyze and make it closer to the reality? And what simulations can I now do to have a better, I would say, different scenarios that I can propose to the business, to headquarter shareholders, in order to provide a little bit more comfort, but in the end also financial and treasury optimization. So that's it, let's say, from my side. I want to end with a nice article in the sense that even if you have all the best processes, tools, and dashboards, which is, of course, at the core of what we do, still we are we need to keep our feet on the ground. That in some cases you cannot avoid what's happening. And as this example explains, two ships can still collide when they forecasted that they shouldn't collide. So with that, thank you for all for attending, and hopefully there are, let's say, some people that want to ask additional questions. Happy to answer them afterwards, or maybe in a couple of next minutes.
All right, Nicholas, you ready? I actually do have a question. Hello?
Yes, go ahead.
Okay. Does your system offer modeling to help with decisions to influence timing and the cash result, such as sales phasing, ship a day earlier and collect it by month end?
Right. Could you repeat the beginning, the start phrase of the question?
Sure. Does your system offer modeling to help with decisions to influence timing and the cash result?
Yes. Okay. Yes. So CashForce, because we have all that process data, meaning from order, shipment dates, invoice dates, payment dates, basically we can play around with transactions, we can play around with groups of transactions, and that's what we didn't cover here in the presentation, but which was actually shown here. It's what we call sensitivity analysis and doing different simulations. So that's exactly what we model in a lot of different cases. And maybe one case that I can relate to is we had a distribution food distributor that worked all across the world in all of the different continents, and they had basically purchase orders, sales orders, purchase receipts, and sales shipments, all of them basically inside the model. And they had to come up with 5 different simulations on what would happen if certain orders were not fulfilled or were fulfilled earlier. So yeah, the answer is yes, but and a couple of nice cases that we can explain related to that.
Okay, Nicholas. Well, at this time, there actually are no further questions. So if it's okay with you, when I send out the PDF version of the presentation later, I will provide your email address so anybody can follow up with you directly. Is that okay?
That's absolutely right. That's absolutely okay.
Awesome. All right. Well, then with that, we are actually going to close today's webinar. I would like to thank you and all the attendees online for taking the time out of their day to join us. I would also like to wish all of you happy holidays and a happy new year. And we have a presentation on January 18th. So I hope you can all join then. And we look forward to seeing you at our next webinar. Have a great day, everyone.
Thank you.
Thank you.